This video covers Chapter 7, slightly different problems than what you see in my notes in Chapter 7 on options. It covers the basics of options, and as I said in class, this material is the foundation to options, and you nearly have to, you should memorize this material. It makes it far easier to work with options later on when you have this information that I'm going to show to you down pat. And so in my Chapter 7 notes, I went through an Apple and I think an Intel examples. Here I'm going to go and use an example right from Alibaba, a Chinese high-tech firm. Just went public recently. The shares went public of the stock, and now the options are trading on the market. And so I went to the CBOE, the Chicago Board of Options Exchange, typed in BABA, and came up with a number of options with different strikes and different expiration dates. I happened to pick the one that you see here. And I printed it out, I cut and pasted it, and circled some important items on this quote. So notice up here in the right-hand corner, the stock price at the time I printed this off was $88.48. It was up $1.42. You probably can't see that to the right. It's up $1.42 for the day. The bid price for the bid for the stock is $88.47. The ask is $88.48. Only a 1-cent spread. That's because there's a lot of activity in the stock itself. Okay. Now here's the calls on the left, and here's the puts that are being quoted. On the left here, you see BABA. That stands for the underlying stock. The 14 that you see, we may look at it carefully. It says 14. That means it's 2014. The 22 means it's the 22nd of the month is the last day that you can trade this contract. And what month is it? Well, there's two ways to figure it out on this quote. One, right here, it says November. And see 85, it's November is the expiration. 85 is the strike. Okay, you can also figure that out from the actual ticker symbol. K stands for November call options. November call options is K. 85 stands for the strike. And they all have the -E, so don't worry about the -E. It doesn't tell you anything. Okay, the last price for this call option was $6.36 per share. So what does that allow you to do? Well, when you buy this option, you can buy 100 shares of Alibaba for a price of $85 a share. The price is $88 at the moment, so we're paying we're paying not only we're paying for the right to get these, to buy these shares at 85, and they're intrinsically worth. You can see the difference here. They're intrinsically worth $3.48. We're paying far more than $3.48. Why? Because we're hoping that the stock goes even higher in value, and so we're paying a little extra money for that possibility, that bet that the stock goes higher and this goes deeper in the money. The net change for the day was 68 cents. That makes sense because the stock price went up $1.42. The stock was up $1.42 for the day. And we know that when the stock goes up, the call goes up in value because calls are bullish. When you buy a call, you want the underlying stock to go up. So this option went up 68 cents per share for the day. The bid and the ask price, $6.20 and $6.60, that's 40-cent spread. Options are not as liquid as the underlying stock. Look, the spread here is only 1 cent because the stock itself is highly liquid. The options are less liquid, and there's a 40-cent spread. That's the dealer's profit. Okay, so what I'll do in a few minutes is I'll show you a long call position and a short call position. And when I get through that, I'm going to cover puts, and I'm going to look at a long put position and a short put position. Here's the puts that I'm going to use. So it's, again, the ticker symbols BABA, that's the underlying stock. The year is 2014, so that's why you see 14 there. The 22 means the last expiration day. The last day this option can be traded is November 22nd. It's still in November. going across this way. There are November options with the same strike. This is calls, these are puts on the right. Okay, the W stands for November with respect to put options, and 85 is the strike. The last trade was $2.79. So for $2.79, you have the right per share. You have the right to sell Alibaba at $85 per share. Okay, you have the right to buy it. Now, you'd never want to exercise this option at this point because it's out of the money. You could sell it in the open market for 88. Okay, but what people are doing here is they're buying these puts with the expectations and the hope that the stock falls below 85. And if it falls to $80, for example, they're going to make some money, profit. Now, this option fell for the day 72 cents, which makes sense. When stocks go up in value, the put goes down in value. And it did. Here's the spread. The spread is only a dime here between the bid and the ask. I'm not quite sure why it's so dramatically high. 40 cents is kind of high. 10 cents looks more reasonable here, between 275 and 285. Okay, so now recall, so what we have is we have a call price at 636 and a put price at 279, and the strike is at 85 for both of these options. Okay, so let's look at a long call, a short call, a long put, and a short put using this information. Okay, a long call means you're bullish on the underlying if you buy a long call. Okay. Now, the payoff for a long call is ST minus K if the stock price at expiration is greater than K. So that would be a positive payoff here. The stock price is greater than K. This will be positive. That's the payoff. It's zero otherwise. Oops. Less than equal to K. Okay. And the profit, so that's the payoff. The profit equals the payoff minus the premium paid. And so let's do a couple of scenarios, and then we'll graph the scenarios and see what the risk and return profiles are for this particular stock. So I'm going to use, just off the top of my head, an ST, stock at expiration, of 75, 84, and 97 as examples. And let's calculate the payoff. Okay. The payoff now. The stock at expiration is 75, okay? And we know that the strike is 85, so let's put up here K, little cheat sheet. K is 85, and the call is $6.36. So now here, at a stock price of 75, this option is out of the money. Right here, it's out of the money. The payoff is zero. And the reason for that is you're holding this option. From the holder's perspective, you hold this option. You would never want to exercise this option, pay $85 for the stock when the stock is trading in the market at 75. You'd actually lose $10 by exercising the option. So you would never do it. It's irrational. And so the payoff is zero. You just would not exercise it. You'd let the option expire, worthless. Now, you had to pay a premium, and that's a fixed sunk cost, $636, and so our profit under this scenario is minus $636. Okay, let's move on to the next column here. A stock price of 84 at expiration still means the option is out of the money. It's only going to be in the money when the stock price gets above K, which is 85. The option is, you would never want to buy it for 85 when it trades in the open market for 84. You can just buy it in the open market for 84. You paid a $636 cost, so that's some cost, and so your profit is minus $636. Now, what happens if the stock is at 97 at expiration? Wow, so at 97, you're up here. Stock price is 97, right? Which is greater than 85. And so the difference is the difference between these two numbers is the payoff. It's going to be $12. 97 minus 85, $12. We paid $6.36, and so we made $5.64 in profit. Okay. It should make sense. The payoff, when you buy a call, the payoff should increase as you go in this direction. As you move in this direction, your payoff should increase. And it does. And your profits should increase also. So let's graph it. So here's my graph. I'm going to graph these numbers. I'm going to graph the payoff, and then I'm going to graph the profit. And so the payoff is, look, it's 0 when you're below the strike for the payoff. It's 0 here. And as soon as it gets the stock price at expiration, gets at 85, the payoff goes up for $1 for dollar. So it goes up $1. The stock goes up $1. The payoff goes up $1. Has a slope of +1, and that's the payoff for the call that's held. The profit is this line, this row, and that is the difference between the payoff and the profit is this fixed $6.36. Slope of 1 in this part. Slope of 0 on the flat lines, right? So this is 636. And so here you have graphically the payoff and profit profiles. When the stock at expiration falls below K, you're going to lose money. And in fact, you could even lose money if the stock is even slightly above K. Remember, this is your break-even point where your profits are 0. And in order to have a break-even point, and you have a break-even point with all these positions, is you have to have something below 0, and you need something above 0 in order for it to cross the line and have a break-even point. This break-even point is profit, not payoff. Profit line. And so you need it to be above this break-even point. And the break-even point is K plus the premium. Okay, so that would be 85 plus 636 to be able to break even. You're going to have to get this stock to up to 91.36 to break even. Okay, so your risk is you can lose 100% of your investment when the stock is below the strike. You can lose 100% of it, but that is limited to only $6.36 per share. So you could lose all of your money, your entire investment in the option, but it's limited to only $6.36. If you bought the stock itself, by the way, the stock itself, recall, I don't have it listed here, was $88. You could buy the stock and it could go to 0 and you could lose $88 per share. Or the stock could go down $20 per share, easily go down $20. But here, you're limited on a per share price of a loss. And you have unlimited upside potential. So if the stock goes through the roof and it goes in this direction, your payoff is way up in this area. Way up in this area. Okay. That was a long call. You're bullish. Let's look at a short call. I mean, the call has been written. You've written the call option. Okay. Remember, K is still 85, and the call is 636. So let's run some scenarios. And before we do that, let's look at the algebraically the payoffs here. The payoff to a short call looks exactly like the payoff to the long call. This is the payoff to the long call, but it's with a negative sign in front of it, because what the long win gains or loses, the exact opposite happens with the short call, so that it's a zero-sum game. Okay, so ST greater than K, and it's 0 out of the money if ST is less than or equal to K. It's technically out of the money when the stock price is less than K, and it's at the money if you invoke this equal sign, that half of equal sign there. So let's run the scenarios now. 75, 84, 97, and let's do the payoff. Okay. Now remember, the payoff, the optionality is a function of the holder. The holder has the right to exercise. When you write the option, you short the option, you're just sitting there and you're at the beck and call of the holder. The holder makes the decisions and you have to follow through on it. But now, will the holder exercise the option at 75? And the answer is no. We kind of already went through that scenario. The holder of the option would never exercise the buy at 85K when the stock is trading in the open market at 75. So it would be irrational for the holder to buy this option or to exercise the option, so the payoff is 0. The same thing holds, by the way, at $84 a share. You can buy it in the open market for 84. You'd never want to exercise it and pay 85 for it. So that's 0. Now, at 97 a share, the holder is like, wow, this is great. I get to buy the stock at 85 when it trades at 97. The holder now is going to expect a profit of $12. Right? That's what we saw a couple minutes ago in the previous example. But don't forget this negative sign here. The gain that the holder got is a loss to the short. Now, there's a premium involved here, right? And I forgot to put the profit here. The profit equals the payoff plus the premium. Okay, payoff plus the premium, because you're collecting the premium. And so you make 6 to 36. And you make 636 in this situation. And you're going to lose 564 in the top scenario. So remember, if the holder is bullish on holding a call, the writer has to be bearish. The writer wants the stock to fall in value so that they collect this premium. And they've just written a worthless call. I mean, that's what writers do. Writers typically write, they're hoping to have written a useless call. So they collect the premium, and they can, when the option expires, they can write another option that hopefully goes, that becomes worthless, so they keep collecting premiums. Just like an insurance company, as I mentioned in class. Okay, let's graph this. We can graph this. The payoff below K is 0. And now look what happens. For every dollar you go up in S, you're going to go down in terms of the payoff. So here's the payoff. That has a slope of -1 right here. Slope is 0 in this area. Kinks at K. Everything in options kink at K. Okay. And notice what you have. This is sometimes called, these positions are called naked positions, because all we're looking at in this chapter is the option by itself. Now, the option derives its value from a stock, but we only own the option. These are called naked positions. When you have the underlying, when you own the underlying and you own the option, or you've written an option on it, then you have what's called covered positions. They're not naked anymore. In this case, we have a naked short position. This is the scariest and the most dangerous of all plain vanilla option positions, because there's no ceiling on a stock price. The stock price can go through the roof in this direction, in which case you're going way down here. You can have infinite amount of losses. with a short call option, a naked short call option. Now the profits here, there's a $6 wedge, so to speak, between these two lines for the 636 that was collected. So you make money when the stock drops, and you'll lose money if the stock goes up. Again, a slope of -1, a slope of 0 here, flatlined. And so that's the graphically, visually, the payoff and profit profiles for a short call. Okay. Got two more to do now. We have the put to deal with. And remember, the put was $2.79 per share, $2.79 per share. So let's do a long put, meaning we own the put. We're going to hold the put. And the payoff to a put that you hold is going to be K minus ST if K is less than the stock price at expiration. When it's in the money, it's going to pay off this guy right here, that amount. It's going to pay off 0 if it's out of the money or at the money at expiration. The profit will equal the payoff minus the premium paid, minus that premium paid. Okay. Now, let's run some scenarios. Let's run the same scenario. It's the same prices. 75, 84, 97. We'll do a payoff. We'll do the profit, the premium and profit. Okay. Now at 75, remember when you buy a put, the stock drops, the payoff should increase. Puts make money when the stock drops, so we should have some positive numbers here and possibly 0 numbers up here for the payoff. Remember, the payoff can't be negative, right? That's what the math up here is telling you. The payoffs can't be negative. So at 12, remember K is 85, and so let's reason this out. If the stock is at 75 in the open market at expiration, and we have an option to sell it at 85, we're quite happy that we own this put because we're selling something for 85 that's only worth 75. We're going to make $10 in value, in payoff, if we exercise this option. The premium that we paid for the put is $2.79, and so our profit is $7.21 per share. Okay. Now, at $84, this option is worth $1. Its payoff is worth $1 because you get to sell the stock for 85 when it's worth 84. It's a $1 payoff, but you paid $2.79, so you still lost money, but not as much. You covered some of your money. Okay. Now at 97, the option is out of the money. You're up here. K is greater than K. I'm sorry. Do I have this right? Yeah, K. K is 85, and the stock price payoff is 0. Right? The option's out of the money. Okay, which is let's see. Do I have this right? K minus S if the stock price is less. And if K is greater than 85, this is 97, 0. I got this backwards. That's what's bugging me. I got it backwards. Let me rewrite this. K is greater than the stock price at expiration. K is less than or equal to the stock price at expiration. That's what I wanted to say. So I had this written backwards. I have this right. These calculations are right. I had this backwards. Okay, so now the payoff is 0. We have a stock price which is at 97, which is greater than or equal to 85. We got a payoff of 0. 279 is the premium, and so we lost 279 on this option. Okay, let's graph. Okay, this is at 85. Now, the payoff is 0 when you are above the strike. The payoff is 0 here. And when the stock goes below the strike, the payoff starts increasing 1 for 1. So the stock goes down, the payoff goes up, and so here's the payoff with a slope of negative 1 in that area. Okay, now let's graph this row. And that row will look very much like identical to the payoff, except there's this fixed difference of $2.79. And so here you can see you lose your money when the stock is above the strike, and you make money when you begin to make money when the stock falls below the strike. And your break even is K minus the premium. In this case, 85 minus 279. Is going to be the break-even point here. Okay, again, remember, you lose money in one area, and you make money in the other. There's going to have to be a break-even point where your profit is 0. Okay. Now, as I did in class, you can fill in some of these numbers. You can at 75, for example. Pray I got my geometry right here reasonably. If you put 75 in here, I'll put a fine point pencil here. 75. Then what that means is you have a $10 payoff. Come up to the payoff line. This is $10. $10. And the profit line is $7.21. So it's not quite drawn the scale. Okay? And then at 84, look what happens at $84 a share. At $84 a share, the payoff is $1. Come up over to here, come over to here, it's $1. That's this number. This number is the payoff is $1 at 84. But we lost $1.79 right here. Come over, negative 179. There should be a negative sign here on that number. And then at $97 a share, the payoff is 0. See, the payoff is 0 right there, and the profit is minus 279 right here. It coincides with the minus 279. Okay, one more to go. Let's do the short put. Now, with a short put, the payoffs are the same as what we saw with a long put, except there's a negative sign. With a long put, right, when K was greater than ST, the payoff was this for a long put, but now we're short, and wrap a negative sign around it so you can see it here. So with a long put, this was the payoff we saw on the previous page, previous example. But with the short put, it's the gain that the holder makes is a loss, right? Is a loss for the short. And so remember that basically what I'm saying is it's a zero-sum game with options. And the payoff is 0 when the option's in the money. When the stock goes high with a put, the option's out of the money. The profit is equal to the payoff plus the premium. Okay, so remember, plus that premium because you sold the option and you're collecting that premium. It's extra revenue. So let's pick the same scenarios and calculate the payoffs. Now, we can reason our way through this, And it's a little harder. It is a little mind-bending compared to the other scenarios. But look at it from the holder's perspective for a second. The holder's perspective. When the stock drops to 75, the holder is happy because the holder is going to get to sell it at $85 per share, remember, right? And at 75, they're happy. They can buy the shares at 75 in the open market, turn around and sell them for 85 upon the exercise. Okay, that's the holder's perspective. But here we're short the put. We are short the put. So that $10 gain, 85 minus 75, a $10 gain turns out to be the loss to the holder. You're going to have a $1 gain to the holder at 84, which means it's a $1 loss to the put writer, to the person short the put. And at $97, the option is to the holder is worthless, because why sell the stock at 85 when you can sell it in the open market for 97? You let the option expire worthless, so the payoff is 0. The premium is always going to be plus 279, plus 279, plus 279. It's sunk. Sunk premium in a sense, sunk revenue. Can't change it. So overall, we lose $7.21 in this scenario, $1.79 here, and $2.79. We make $2.79 here. We sold a useless option in this area. We sold an option that was worthless, and we're happy that we did that. The holder's not happy because they're down this negative 279. Okay, let's graph. Okay. Let's graph the payoff. Now the payoff is 0 when the stock price is above the strike. Okay. And it starts as you start moving in this direction, down. Move in this direction down. You start to lose money. So you lose money with the stock drops in value, the payoff drops in value. Okay, that has a slope of positive 1. Slope of positive 1 for the payoff. The premium is 279. It's constant, so you're going to have a constant distance of 279 here. And this is your profit. Again, a slope of 1. So this is your profit here. This is your payoff on that line. So, to summarize, as I did in class, you have, sometimes these are called hockey sticks. The hockey sticks all kink at K. Okay, for all these positions. And so the profit for a call looks like that type of hockey stick. When you buy a call, when you short a call, it looks like this. When you buy a put, it looks like this, and you short a put, it looks like this. So, as I said in class, no matter what strategy you have, or no matter what direction you think the stock is going to go in, you can take advantage of it using options, because we've got every scenario covered here. So remember, you got long call, short call, long put, short put, and those are the hockey sticks. So you should have those shapes of those hockey sticks burned into your memory, because that'll, like I said, it'll really help you later on.